Kia ora, and welcome to today's Daily Chorus. It's Tuesday, August the 12th. I'm Bernard Hickey for the Kaka. This is my daily podcast and video that goes out in an email newsletter via Substack for the Kaka, and it's all about Aotearoa's political economy around housing, climate, and poverty. The economy is something that is closely linked to support for the government, and this is something that Christopher Luxon, the Prime Minister, has tied the future of his own government and his own position to so far this year. He came out at the beginning of the year and said this government was all about growth, 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 and will do whatever it takes to get that growth. However, it has continued to suppress government spending growth and to continue on with a freezing of new house building by Kāinga Ora, an initial delay of new school buildings through 2024. It's back up and running again now, but that was a year when school buildings were on hold. We've also seen hospital planning suspended and capital grants halted and suspended for transport, which has affected councils in particular. We've also seen capital grants and the arrangements for capital for councils suspended or cut, and that has seen councils feel like they're forced to put up fees and charges. So the overall government strategy, which is to try and restrain spending growth, get the government deficit down, take pressure off mortgage rates, lower interest rates in order to boost the economy, is all very conventional and has worked before for the New Zealand economy. However, this time is different because the Reserve Bank is restricting lending growth by the banks to first home buyers through loan to value ratio restrictions and to rental property investors through debt to income multiple restrictions. And also, it turns out a lot of people don't want to buy houses when they're not increasing in value. And certainly people don't want to sell houses when they're not increasing in value, particularly if they're still 10 to 20% below their peaks. And the combination of all these things, along with real wage deflation, is meaning that the economy is actually back in recession, a double dip recession. And so that's what I want to talk about today. What's happening with our political economy, the connection between the two, and what we know about the popularity of the government and why the economy is not growing as the Prime Minister would hope. So last night we got a One News Varian poll showing the Prime Minister Christopher Luxon's support as preferred Prime Minister down 3 percentage points in a month to 20%. He's now barely above Chris Hipkins on 19% for Labor. And that tallies with what we've seen with the other polls as well. Now, this is a chart showing preferred Prime Minister for various Prime Ministers going back to 2011. And you can see the right-hand side of the chart as you read it. The blue line is Luxon, the red line is Hipkins, and essentially they're neck and neck now. And significantly lower than what we saw for both John Key and Jacinda Ardern from most of their terms. And when you go back through the history of preferred PM polls, you can see that Luxon for a new Prime Minister, because often Prime Minister's popularity decay over time. For a new Prime Minister, his are the lowest since Jim Bolger. And I don't think that's completely coincidental, because remember that Christopher Luxon is using the same strategy as Jim Bolger and Ruth Richardson, which is cut spending, cut deficits, lower interest rates, and spark a housing boom. But it's not happening this time. And that's because back in 1992, household debt was barely 50% of disposable income. It's now 170%. There were no restrictions on LVRs and DTIs. The banks at that stage mostly looked after businesses, hadn't gotten around to learning how to become mortgage banks, and they were just removing their own shackles from the pre-Muldoon era on mortgage lending. So there was a real prospect of a housing boom, and there's been several since then. The question is whether you can have another one when you cut interest rates. And you can see there, according to voters, they've taken Christopher Luxon at his word that he was going to look after fixing the economy and improving costs of living. The trouble is his strategy involves a bunch of government spending cuts and new fees and charges that have led to inflation. And secondly, he can't control many of the international prices that flow through, particularly in food and also in fuel. And he also can't seem to control the prices charged by our duopolies and quadrupolies in supermarkets, banking, and electricity. And that is meaning that the cost of living concern is very much in place. And you can see that in a chart from BNZ, Mike Jones, showing what's happened to disposable income growth in the last 7 or 8 years. That's the yellow line. And remember, it's below one. When it's below zero, that means you're essentially getting real wage deflation. And you can see it's back there again. And obviously, it was there for a significant period through 2022 and 2023 when inflation was up. The household net worth, you can see there, rose very sharply from March 2020 to March 2021, thanks to the removal of the LVR's $50 billion worth of money printing and just as much free lending to banks, which was passed on into the housing market. And then it's flattened out. Now, actually, if you look at net wealth from equity and housing, that's down substantially. But of course, the stock market and other asset prices have increased. So net, you're basically flat for household wealth. So what you can see there is that there's no help from the balance sheet, and there's no help from wages, and there's no help from lending credit. So the economy is not growing. Just to reinforce it, here's another measure of what's happening to costs of living. Now, the dotted line there is essentials inflation. So this is not CPI inflation, but essentials inflation. And you can see through 2021 through to 2020, early 2024, it was well above the light green line, which is the labour cost index, i.e. taking into account the rise in wages. And you can see there the big gap between the dotted blue line and the light green line. That is effectively real wage deflation. And we're back there again, according to the latest numbers on petrol, energy, food, and rates. And just to top it all off, a really interesting chart again from Mike Jones, which I've referred to in the email newsletter. Average hours worked per week per person has dropped from around about 30 to 36 in the early 1990s, down to around 32 and a half in 2025. Now, there's a bunch of, they call compositional issues going on here. Obviously, there's a lot more people working part-time. There are a lot more people over the age of 65 working, and therefore they're more likely to work part-time. People are doing a lot more so-called variable hours work, so contracting, 0 hours type labour. And that is seeing average hours worked per week per person drop to a record low outside of the 2 COVID lockdowns. So that is a substantial drop in household income, assuming, of course, those hours are paid. And that is playing into what we're seeing with the malaise affecting people's consumer confidence, retail spending, and of course, government popularity. I'm Bernard Hickey. That was today's Daily Chorus for Tuesday, August the 12th on Vakaka. Ka kite anō.